The Federal Reserve is about to start its monetary loosening and is likely going to cut interest rates at its next meeting. And now the market is starting to price in a cut of 50 basis points at this first meeting, and then having a total of 200 basis points of Fed rate cuts when all is said and done. James here isn't buying it. Tell me why.
So the Fed historically, look back the last 30, 35 years, the Fed has only done two types of rate cutting cycles. The type we'll most notice are 2000, 2008, and 2020. The Fed aggressively took rates to zero or awfully close because there was a major negative economic shock. In 2008, it was the housing crisis. In 2020, it was a novel coronavirus. Now, the other side of the rate cutting cycle is not this aggressive move back down to zero, but what the Fed typically calls a mid-cycle adjustment, Nathaniel. And that's a tinkering. It's a calibration of policy, usually 75 basis points or so, because the Fed doesn't necessarily see an imminent negative economic risk, but it wants to bring their policy better in line with where the risks might be. So no, not a shock right here, right now, but there could be some things brewing down the pike, and we might want to adjust policy a little bit to get ahead of that. And so the most recent example of this was the summer of 2019. There was a trade war, there was some manufacturing weakness. And so what did the Federal Reserve, led by Jerome Powell, do at the time? Well, they cut 75 basis points. They cut at the July meeting, the September meeting, and the October meeting. They called it a mid-cycle adjustment. And what they also did, Nathaniel, is they framed those cuts in line with what they did in 95 and 98. And so as a studier of the Fed, one thing you'll know is the Fed is really big on past precedent. They're really big on the historical playbook. They often think about their moves today and how they might have mirrored moves in the past.
So you're not buying this talk about 50 basis point rate cut at the next meeting?
I'm not.